Thank you, Zach and Micha, for joining Nicole and I today. We're super excited to welcome both of you to the first of many webinars talking with operators, entrepreneurs, and investors to learn more about how they got to where they are today and better understand how existing early stage founders can leverage a lot of the do's and don'ts that you gain throughout your experience as a founder to become who they want to become. I will start off by just providing a little context as to who is Kli Capital, the firm that I am working at. Nicole will then jump in, provide some context about Ibex, and then we'll jump straight into questions. That sound good? So Kli Capital was actually started 6 or 7 years ago as BNSG Capital, an early stage private investment fund. The goal was to really identify a couple early stage investments a year. Check size is really $250 to about $1 million, and we are fully agnostic in terms of industry and geography.
Cool. Thanks everyone for joining us. Good afternoon and good evening wherever you are in the world. So my name is Nicole Priel. I'm with Ibex Investors. I live in Israel and that's why it's dark outside. Ibex Investors is a US-based firm headquartered in Denver with offices in New York and Tel Aviv. We manage a bit over $700 million today across several strategies, both a hedge fund and venture capital. And I lead our $100 million brand new early stage fund that's focused on Israeli founders. It's early stage, and we also have a complementary growth and private public equity vehicle that also invests in Israeli companies. So that's it. That's it for myself and with Ibex. And without further ado, let me introduce you guys to Zach and Micha, who are the real stars of the show. So Zach and I happened to actually grow up in Manhattan together, and we did the Maccabi games together, but he's more commonly known for his entrepreneurial success in the areas of ad tech and health. He launched Invite Media and pioneered impressive cancer research with Flatiron Health. Zach is and continues to be one of the most prolific angel investors in the game today. He launched multiple startups out of his dorm room, ultimately finding huge success with Invite Media. He sold the company to Google for more than $80 million in 2010 at the age of 24. Following the success, he launched Flatiron Health in 2012 with the goal of pulling patient data from electronic health records in a way that could answer scientific questions and improve medicine. The company raised $328 million, and as a result, Zach and his co-founder Nat Turner headlined the 2015 Forbes 30 Under 30 healthcare list. Zach and Nat eventually sold Flatiron for almost $2 billion to Roche. Zach still remains active in the startup scene, investing in 10 to 15 startups a year. I'll leave it to him to share some of his notable investments. And Micha Breakstone, who's also with us, is a repeat entrepreneur whose latest startup was Chorus.ai, which has raised $100 million to date. He holds a master's in math and a PhD in cognitive sciences. He's also co-founded Founders Club Tel Aviv with over 250 active members and loves working closely with founding teams to build their startups. Micha is passionate about the marriage of language and algorithms and believes that building human quality NLP technologies is a critical step towards achieving AI's ultimate goal of empowering rather than replacing humans. So let me turn it back to you, Elias, to kick it off with questions.
Thanks, Nicole. So the first question that we have for both of you today is really about learning more on how you got started. So I guess Zach can begin, but Zach, why don't you walk us through, what you were thinking and really what was that minute when you were like, I'm going to go start Invite Media and then eventually Flatiron Health?
Yeah, I mean, a little different between the two. First one is always harder, I think, but the short story on Invite, we had an internship, and we had interned, my co-founder and I, at this company in San Francisco over a summer, and had gotten exposed to the online ads industry kind of like from the inside out is how I like to think about it. So pretty typical founding story, actually, except we were just younger, but in general, like the same idea. You work in a company for a few years, you understand the industry, you understand some of the technology, and you kind of like spot a gap. And that was the founding of Invite. We had seen some of the back end of ad tech and had an idea from that experience. And from there, it actually looked very, quite different. We ended up basically building what I would call like a giant advisory board of key individuals who would just teach us about the industry. And after we sold it and then obviously switched industries to healthcare, we kind of ran the same playbook, which was, start fresh, but surround yourself with just like incredibly smart people who know the details. And so most of our experience has been talking to people. There's a lot of people that can learn from like reading, I don't know, a 50-page industry report. I mean, I get bored after like the first 3 paragraphs. I just can't learn that way. So we would go out and talk, hundreds of meetings, not, like 5-10 meetings, but literally I have notebooks like this big filled with kind of primary research, in particular in healthcare. So it was really just, learning the details over time. And I think each business from, first idea to like actually launching the company was probably about 18 months or so, each one. There was a huge time period up front of homework. So, yeah.
Awesome. I wish I had learned Zach's way. I was much more whimsical in the way I started off my career in entrepreneurship. I was actually doing my PhD or part of my PhD at MIT, and I was walking through the Infinite Corridor, and there was a poster there saying, if you're not embarrassed to show us what you, or your demo or something like that, you've waited too long. And I was like, hey, I can build a demo for something I thought would be really cool. I thought it would be it was 2010 at the time. I thought it would be really cool to build, at the time it was a Rosetta Stone for mobile phones or for smartphones. I love learning languages. So I was like, hey, I can teach languages based on your, I don't know, Facebook feed, LinkedIn feed, or whatever it was, and kind of tailor lessons on the fly. Didn't know anything about the space. Got co-founders that were back in Israel at the time. Didn't know anything about entrepreneurship. Ended up getting into the MIT 100 program and advancing a few stages, but completely flopped. So I had to learn more like that Zach's way for the later ventures. But yeah, Chorus, I was introduced to co-founder. I love the space of NLP, so had been working on that for a long time and knew the ins and outs. I was working at NLP for 7 years at the time or so, or maybe even longer. So I knew what the strengths of the technology were, where the hacks were, how to get, make huge progress very quickly. And kind of that was my superpower, so leveraged it. Yeah.
Very cool. Can you tell us a little bit about, the early years building your companies? How did you decide on your first hires? How did you choose your co-founders? And then ultimately, how did you know when you attained product market fit?
Zach, you want to go first? Sure. So there's 3 really large questions. I'll take maybe 1 or 2 of them. First hires. I always try to take people that, are company builders, people that are, they're as dedicated, or almost as dedicated as their founders. They absolutely love to build. They love to build not only software, but teams and companies, and they kind of thrive on building something larger than themselves. So that cultural fit is so important, especially at the very early stages. So identify those, the word 10X is overused, but people that are 10X in the larger sense, not necessarily as engineers, but people that will help you attract the stars later on in the game. One of my ventures, I brought in the person that ended up bringing 4 of the researchers along with them and basically helped me define the company. So look for people that, will make great entrepreneurs one day. If somebody tells you they're not sure if they want to join the company or start their own company, I think that's a great hire. And obviously check for values and stuff like that. So yeah, those are I answered 1 of the 3, the first hires. I'll pass the microphone over to Zach for the rest.
Yeah, I mean, just to touch on that, we had a very specific strategy, which was we looked for people that were well-trained, and specifically for people that had come from basically like well-run institutions, because my idea or my thesis, if you will, was like, I don't have time to teach you how to be good at your job. at a Google or a Facebook or wherever, some giant company, I can come and hire someone with raw talent and train them up and, take some risks and make some mistakes. But when it's like 3 people or 4 people or 5 people, you just don't have that ability to make those mistakes. So we were kind of snobby, honestly, about it. Like we said, all right, show me a top tier company or a top tier place that you came from, and show me a history of career progress. I wanted to see somebody who had got promoted in their previous jobs. And that's definitely not the only way to do it, but it was our way of reducing risk. There are plenty of people who don't have that background. They didn't work at McKinsey or Bain or wherever and are good at it. But our philosophy was like, we don't have the time to find those people. And so let's just kind of narrow the funnel and swing for the best talent we could find in terms of training. So if you look at like Flatiron's first 10 hires, they're almost all exclusively former Facebook, Google, McKinsey. We had a Bain leader as well. And people disagree with that approach just because, it feels like, oh, okay, well, you have to have this like perfect background. And my answer was more, it's just predictive. It's not the only way to do it. So we tried to shortcut it that way. And then our criteria for hiring got looser as we got bigger. From the product market fit thing, I mean, it's tough. It's definitely a judgment call. A lot of what I looked at, it was like when we were out doing we did like hundreds of customer interviews. And if they would follow up after the meeting, like if they were the ones pinging us and instead of the other way around and asking more questions, I always felt like that was a really good indicator that you've got something. If you have to like hound somebody and chase them down, there's not a pull, right, coming from the customer. And by the way, the same is true of VCs, right? If you go and pitch a VC and they're not back to you within 48 hours, they're not interested. Whether they say they are, they're not. So we kind of looked for like small behavioral indications that there was a pull. And if there wasn't, try and understand, why, what was going on there. And we did all of this work face-to-face because we were an enterprise software company. I think if you're a consumer business, it's a totally different game, right? You can look at metrics in the app. But as like an enterprise company, you just don't have that ability. You have to be talking to a customer, whether on Zoom or in person.
Gotcha. Thanks. And what do you think the biggest mistake you guys made throughout your entrepreneurial experiences, right? Like, what do you wish you knew when you started the company that you learned throughout that process?
I can give you two from my end. Again, this is unique to our experience, but obviously we went into healthcare, right? Which is like a complex, specialist-driven industry. And I think one mistake we made was just not hiring a specialist early enough. In our case, it was an oncologist, right? We had tinkered with the idea of hiring an oncologist early, but they're really expensive and they make a lot of money, whatever. And so I think we waited too long and made some really bad decisions in the beginning because we didn't have that person kind of telling us what to do. That was a bad one on our end. The other thing was more for me is like a growing up exercise from the first business to the second was like how important it is to be good at sales. I think a lot of technical founders kind of assume like, oh, all right, well, I'll just build like the best product and that'll do it. And the reality is like that just doesn't work in most industries. I mean, some sure, but if you're selling to like other engineers maybe, but in most cases where you're selling to like a non-technical buyer, you have to be good at selling. You have to be good at telling that story. And, I was terrible at it in the beginning when I was, early on, and then had some really good advisors just kind of yell at me a bunch and slowly teach. They yelled and then they talked on like how to do it better. And now I really enjoy it. In the beginning I hated doing it, but now it's fun. So, yeah.
I'll share 2 of the mistakes I've made or me and my founders made. I think one is waiting before starting to sell the product. So we had an amazing product and basically waited until it would be even more perfect before hitting and running. So I think we could have gone to market much earlier on. That's one. Probably a lot of people do that. You don't need to be perfect to do something good. Another one, I'm forgetting. It was actually related to something that Zach said. Selling. It'll come back to me. I submerge. I don't like thinking about my biggest fiasco. So I think, yeah, you know what, defining roles and responsibilities, and maybe even another more important one. When we founded Chorus initially, we had, I think, a really compelling vision, which was to unlock the hidden dimensions that covered decision making in audio calls, and later on it was to understand and enhance human communication. I think our strength was on our vision, and at the end of the day, sometimes we went too small and basically build a productivity tool and didn't go as quickly as we wanted to towards our vision, which I think is still compelling today. So I think stay true to your vision and always think as big as you can. Maybe that's something I would like if I return 5 years back.
Yeah, great anecdotes. And something I constantly try to remind myself is don't let perfect get in the way of good, because otherwise you're just never going to get there and you're never going to execute. Like Zach, what you were saying, it's like you pick a number, 10, 20% technology and the rest is execution. So a lot of technical founders definitely wait too long. So selling is so critical. How did you guys basically move from the initial hustle of getting $500,000, $1 million in ARR to really, scaling that whole process? Like, how did you go from literally knocking on doors to saying, okay, now we can replicate this?
Yeah, I mean, I guess on our end, two things. One was we built a sales team, and we tried our best to do it when we felt like the sales process was repeatable, where like you didn't have to change the deck every single time you had a meeting for the next one. That was like my measure of success, was like, how often did I do a pitch and then I went back, I'm like, oh shit, I got to change something in this slide deck because it's not working. And when that stopped happening, it was like, okay, I can use this deck over and over again. We started to ramp up the sales team. And we had, a decent, not a huge, but like a pretty decent sales team that we had built over time. And that was it. That was, it's like just time and effort really of making sure we had coverage of every major account. And we were, knocking on doors and making sure we were in the meetings. And I think, it's scary. It's scary to have somebody out pitching your business. But I think a lot of times founders, at least the mistake I see them make, is they assume that like the minute they hire a sales team, that means they don't do any sales. And that's just not true. Like what it means is you just do a smaller percentage of the sales. But up until the day we sold, and even after we sold Flatiron, this is like 7-8 years in, I was still doing sales 25-30% of the time. We just had a lot more people doing it as well. So.
Cool. So my answer isn't dissimilar. You hire a great leader after you have the first AE, the first few AEs. You bring in a team lead, or you bring in later on a director, and they spend a lot of time coaching and building out a playbook or formalizing the way your sales playbook that is already working, and hire other great people along. And it moves pretty quickly once you have that.
Makes a lot of sense. So going back to, I guess, the first question on the story on how you guys actually started each one of your companies, Micha, you spoke a little about how you were into NLP, and when you were getting your PhD at MIT, it was always a topic of conversation that interested you a lot. So I guess my question is, how did you arrive to the industry in which you decided to start a company in?
Yeah. So the first company I founded was a very fabulous failure. So it was also a failure also on a personal level. I had to learn a lot on the fly. How to manage relationships with founders, how to raise money. So I wouldn't, it's something bad to learn from. I basically dropped into it or fell into it or tripped over it rather than actually learned. Later during, other companies, it was a much more organized and thoughtful process. How to choose your co-founders, who you want to work with, and then asking yourself, where is your passion? What do you feel like you want to be doing? That's number one. And number two, what are the types of people you want to work with? What are the roles you want to be doing? How do you want your day-to-day to look like? Stuff like that. So, my entrepreneurial journey is many ups and many downs. And it's I see it, more as a reflection of really the way you live and what you want to accomplish. I always saw myself as a creator way before founding I started late. I started at the age of 30 or so. I always was extremely creative. I just thought I would be a novelist right after I finished my PhD. But as I started actually creating, not only as an engineer, but actually building a company, there was extremely, extremely fulfilling. The excitement, the ability to impact people, the ability to build this small environment where, like, it's a small entity within the world where you can actually make lives better, even if it's only internally at the beginning before you start selling and externally. It just felt like a really nice way of making your life more beautiful and more meaningful.
Thanks, Micha. We had a question in the chat about fundraising. So can you guys share a little bit about how it was going out to the market and trying to raise money for Chorus and for Flatiron, and how many rejections it took until you finally got that one yes, and a little bit about what that process was like and how you kind of recovered from the rejections and kept persevering.
Zach, do you want to go? I don't mind starting. Chorus was easy. We were a very, very strong founding team. We spoke with a few angels that immediately said, well, we're in. The concept was cool. We had an amazing demo, which was jaw-dropping, even to people who understood how we built it, even to NLP experts or ASR experts. It was really, really cool. We had it was just moving. So it was psychologically very strong. And we spoke with one or two VCs in Europe that said no. And then my previous, my ex-co-founder and I flew out to Sand Hill Road, basically. And we met about 10 VCs in the space of 2 or 3 weeks and ended up with 3 term sheets with great terms. We flew back. I flew back to Israel. He flew back to Switzerland. And we just had to decide. So it wasn't, unlike a lot, this was a Cinderella story in the sense of how easy it was. Maybe it wasn't good that it was so easy. Maybe had we spent the 18 months ahead of time like Zach did, we would have known better how the market looked like. But we just had a concept that we knew was right. Our motto was, you can't improve what you don't measure. We measured the sales call. We had this beautiful slide of this technician holding up a telephone with an X-ray vision. So it's like anybody could understand, could get that. And we were very lucky to get term sheets extremely early. What we did do is we leveraged, we had a $1 million safe from great angels, and we leveraged that. So we knew we could walk away from VCs as well and start building the product alone, which it's always good to go into quote unquote negotiation with some leverage. VCs at the time, there were VCs that said no. The 2 kinds of VCs we saw were VCs that said, this technology that you're talking about, at the time it was 2015, we were doing large vocabulary, continuous speech recognition for sales conversations. They say, this simply isn't possible. And the other kind were people that just gave us term sheets. So it was relatively easy for us at Chorus. But I can say for other companies, it has been much, 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 much harder, sometimes impossible. So that isn't usually the case, even when you have a strong team.
Yeah, I mean, I'll only comment on the first time around because the second time was easy, but the first time is really the hardest. And I know I always thought of fundraising as like an auction rather than a market, where everyone isn't like there's people bidding on your company every single day. There's no assumed price or anything like that. So you're basically just trying to convince like one person to do this, and then the rest will follow. And so it was a volume game. We just tried to do as many meetings as we could and improve on every pitch, or really understand like why they were saying no, and try and dig into the details so that we knew, okay, was the no because of like some of our storytelling, which we could change and improve on, or was the no because of some disagreement about the market or the product hypothesis, which is harder for us to change, obviously. So, just trying to like really understand why people are turning you down. And we just kept trying. And eventually, we got 2 groups to say yes and kind of off from there. I think where people make a mistake is they just assume that like there's a VC market, and in reality, what there is are like lots of pockets of investors, and you just kind of have to get one of them over the hump. And sometimes people say no because they're tired that day, and or they're just not interested, or they're busy, or what. I mean, I say no to companies sometimes just because it's like, look, I just don't like this industry. I'm not interested in it. I'd rather do something else with my time. It has nothing to do with you. And so you need volume. You need to do, I mean, I tell most founders, aim for 25 firms if you can. If you can get 25 intros, if you haven't gotten funded after 25 intros, there's probably something wrong with you. But that's a good number of shots on goal. And so aim high and work your way down.
Gotcha. And obviously both of you ran and continue to run very successful companies. How do you guys think of work-life balance?
Can I give I have this because I get asked this question. I used to get asked this question at Flatiron all the time. I guess because we're like a New York, business, and it's a work-life balance. I don't believe in it when you're early in your career. I think work-life balance is something that you earn. It's something that you kind of like grow into over time because you've built up your skill set, that things that used to take you 5 hours take you 30 minutes, and things that used to take you 3 days, you can do, with a team member. It's something that like you earn the right to have a work-life balance. You don't start there. And especially as a founder, you don't start there. And yeah, that, anytime I talk to founders in particular who said, yeah, we're just trying to balance, work and other stuff, I'll pass. Like you don't have that luxury when all of the cards are stacked against you. And I tell this to our employees too. I said, look, if you're coming here, this is your first job or your second job, and you want to put in a 35-hour week, like it's probably not going to work. But as that skill set gets better and better and better, and you're more leverageable, if you will, then yeah, you can kind of figure out how to balance the two. But the idea that when you're 25 that you have to have work-life balance, to me is ridiculous. I just don't buy it.
And what would you say in the case of individuals that have a partner, wife, kids? How have you been able to manage that?
Yeah, you have to pick. I mean, you can do, I think you can do like startup plus family. I don't think you can do startup plus family plus social life plus, time off to read plus like watching all the new movies that's just not possible. You can do like 2 things. I just don't think you can do 3+ things, at least not, super well. If you're a second-time founder or a third-time founder, you can do anything really, because like everything is easier. You've done it before. You've seen these problems before. You have better talent you can recruit. You have more money. All the like stuff that hurts first-time founders kind of goes away. But as a first-time one, I feel like it's the startup. That's your first marriage, really. And then, the actual marriage is your second one. And after that, it's going to be pretty tough.
Gotcha.
Yeah, so I'm entirely with Zach on that one. I also, I'm a workaholic by nature. I actually love work. I love working on a startup. Interestingly enough, I've left Chorus about 9 months ago for the first time probably in the last 4 years. I'm actually in a relationship that is established. So maybe that's somewhat telling. And I hope she's not watching it now, right? Talk of work-life balance, because she'll say you don't have any work-life balance even as you're founding a new company now. But I completely agree with Zach. I mean, it's not that you have to live a crazy life, not at all. But building a startup is not like building a different business, and it's a full dedication. And also, if you don't want to be dedicated to it, go find a different thing to do with your life. I mean, part of it, that's part of enjoying it. I mean, it's you have the privilege of creating something new.
Cool. Yeah. Maybe slightly contrarian views, I have to say, but refreshing to hear. And I don't disagree. But I would love to turn it over a little bit and dig into your investing focuses today. So, Zach, I think you're pretty active. It would be great for us to learn, as an audience, what your thesis is and what you're looking at these days and how you conduct your process and where are you investing. I think that you invest both in the US and globally. In Israel in particular, you've been pretty active. So you want to give us a little bit of background on that?
Yeah, we're definitely active. We've probably done maybe 40, 50 deals a year, give or take, across what I'll call pre-seed, seed, and Series A. Our preference is to invest when the company is still immature in its like operating infrastructure. Maybe they have like a head of engineering, but they don't have all the other functions built out, or they have a few customers, but it's unclear if it's repeatable yet. And we'll go earlier as well. And we'll do pretty much anywhere geographically. It doesn't really matter, although we prefer the US and Israel. But we have a bunch of investments in Europe and one or two in India, and actually one in Southeast Asia. But it's all early-ish stage, where like, the best way I think about it is like, you can't look at a spreadsheet and understand the company. As the companies get bigger, you can spend more time in the spreadsheets. And for us, it's really always looking at two things. It's size of market, which is not rocket science, right? Like, how much money is there in this opportunity broadly? And then the founder. And does the founder like really understand the details of the market? And almost to a point where I'm a little less like concerned about the actual product idea per se. I mean, if you're an A or B company, we'll take much deeper look at the product. But if it's seed or pre-seed, like the product idea is one thing. I'm actually a lot more interested in like your understanding of the market. Can you tell me about your competitors' pricing? Can you tell me, why this feature and not that feature? Can you really explain like all of the details, both technical and competitive, in one person? So we do a lot of like, Chris Dixon likes to call it the idea maze. It's like, can you explain to me the different ideas and why they're different when, they look all the same? Later stage, we'll look at the actual products and numbers. And that's it. We write checks anywhere from like 200,000 to we've written up to $1 million now in a few companies. Almost always as a partner in the round. So we don't lead, we don't set price, we don't do anything like that. It's really meant to be, if you're a founder and I think of it as like, who do you call Tuesday morning when you've got a problem, right? You're not calling your board. You're probably not calling your lead investor. You want to call them when you have like really good news. But when you have a real problem, like who do you call? And that's our value prop. We've been in your shoes. I've dealt with how do you deal with underperforming executives and executives who are fighting with each other. It's all like people stuff. And so that's kind of the value prop to the founders. Look, we've been in your shoes and we're aligned with you. So call us, tell us what's going on, and we'll see if we can work it through with you. So that's it. Yeah, it's been pretty active though. I mean, ever since we sold the last business, I think probably a deal every week or two or so.
That is really active. Do you have any sector industry focuses or areas that you don't touch?
I would say most of the time it's software. Or software enabled. So maybe the product isn't software, but the tech is what drives the differentiation. But we'll also do what I would describe as like complex manufacturing or any sort of complexity where if it works, it's unlikely someone will be able to compete with you because the way your product is made or the way it's developed is just really, really hard. So we've done some like fake chicken companies because of the manufacturing process. We've done a coffee company in Boston, which is also like a manufacturing play. But there's usually like a core technical component that creates the moat. And then every once in a while you meet a founder who's doing something crazy and you're like, you know what? I don't normally do this, but sure, why not? You seem great. But that's like, 5%.
Have you ever invested in someone who like reached out to you cold on Twitter?
No. Not yet. At least. I should say not yet. I've taken a meeting or two, but we've never said yes that way at this point. With that said, sometimes I'm sure people like find their way, to an intro from somebody I know. But as of now, no. I don't know what that says though. I'm not sure that's like maybe I'm just bad at it.
So how do you prefer that founders reach out to you?
Through a shared connection is usually the best way, either an existing founder that we know, someone we've already invested in. That's definitely the best signal for sure. or through other venture funds, some VC, other investors that you've met. We do, I would say nearly 100% of the time, we are co-investing alongside another firm, group, whatever. And so a lot of, maybe half of the ways we get introduced to people are through like a shared investor, through some trusted source, basically, is the idea. But or Twitter if you want. The idea just has to be really good. That's all. Yeah.
How are you?
I'll chime in. Sorry.
Go ahead, Micha.
Yeah, I'll chime in. So obviously my checks are much smaller than Zach's, and I look for things differently. I invest also as an angel and also as a scout for an Israeli VC. So I haven't invested in anybody that pinged me over Twitter, but sometimes I identify people that I actually really want to invest in and kind of like badger them for half a year until they're willing to found a company, which is very counterintuitive, but so some have done actually quite well. So, and sometimes I know people do want to found companies, but they don't know what the right time is or what the right partners are. So I was lucky enough to convince a few people to join forces. And my biggest success in that regard is a company that actually in your space, Zach, a company called Immunize that does AI for immunotherapy. I introduced the founders to each other after literally running after two close friends of mine, forcing them basically to meet up and saying they would be happy together. So that was, I felt very privileged for that, anecdotally. So very different process, obviously. And I invest only in people, just it's so early. It's pre-seed, usually the first check of a few tens of thousands of dollars. So the decision is very different. It's basically giving people a first signal that they are worthwhile, basically. You're good. We love you. Do something. So it's much earlier and less thoughtful than Zach.
Well, I don't know. I mean, honestly, a lot of what we do is like person market, and that's it. I just remember, I'll give you like an anecdote because I always find this one to be interesting. Back when I was at Google, this is like 2011, we were starting to do some like early angel investing. I don't remember exactly where the intro came from, but I got introduced to the founder of a company that's now Bark, which is like a few $100 million recurring revenue in the pet market. And I remember I read the email, I took the meeting, and I remember walking into the meeting being like, there's no way I'm going to do this. Like, first of all, I hate dogs. I don't really like pets broadly. I have like no interest in the space whatsoever. And like, where's the technology? Like, this doesn't make any, but I was like, I was bored. I took the meeting. And then I remember Carly, the woman who was pitching it, she pulled up like the third or fourth slide. And it was a slide that talked about the average discretionary spending of a dog owner in the United States, which was like $1,300 or something crazy. It was such a big number. It was bigger than like people spend on clothing and things like that. And I just remember looking at that number going, wait, that's how much people spend on their dog like every year. And most of the spending is done retail, like in person. And I said yes on the spot. That was it. That's all it took. It was just like a very clear, like, I didn't realize how big this thing was. And she obviously knew all of the details. And so, it wasn't like I did some spreadsheet analysis of their margin structure or anything like that. It was just a really smart founder who explained to me a fact that I didn't know. And now, that thing has gone on to be a pretty big business so far. So, sometimes it's that.
And how are you thinking about investing through the pandemic? I mean, a lot of VCs, private investors, have either put a pause, have redefined their thesis, only focusing on things that have grown tremendously because of the impact of the pandemic, like telemedicine. Have you shifted your thesis on what you're looking for in a team, in a product, in the market, et cetera?
We haven't really. I mean, there are certain things we'll stay away from for now, like certain travel related ideas. I think we're just going to hold on because you just can't tell. But mostly we'll keep the same strategy. I think good companies are formed when the world is shitty, and there's good companies that are formed when the world is great. And, a lot of the best companies actually were started right after the financial crisis in 2008, where, it kind of sifts out the people who really want to do it from the ones who don't. So we didn't really change much. Yeah, I can tell you what's changed is they're all over Zoom. That's really been interesting. Like all the meetings are over Zoom. I haven't met a founder in person in like 6 months. And so yeah, I think you can actually do more. Maybe that's part of the, you know, I have to like travel between meetings and things like that. And we can do a lot more ex-US founders as well, because you're not waiting for them to come to New York to meet. So no, we haven't changed too much. Pretty active.
Do you have any view, guys, on, you know, a solo founder versus 2 or 3, or like if you see 4 founders, is that a red flag? Is a solo founder a red flag? What do you think? Is there a magic number?
For me, it would take a lot to invest in a solo founder, just because I know, especially if they're first timers, it's just so hard. Even if they are successful, then I wouldn't wish that success on them. It's like just so extremely hard. And also it may be a red flag, not that it's so hard to do, but why weren't they able to bring in another founder, or are they, you know, too self-centered to not want to share, or they think they can do everything alone? It's not only that, even when I see founders that aren't equal, I need a very good explanation of why. I like interests being aligned. And in terms of 4 founders, it's not terrible, but it's, you know, 2 or 3 are usually the magical number. Although statistics, I think, you know, everybody will say no solo founders, no 4 or 5 founders, but I think statistics actually show the opposite. There are quite a few successful companies started by a single founder, and there were quite a few successful companies started by 5 or more founders. So I don't think it's a statistical thing. It's more of a preference for me.
Yeah, I think like we don't have hard, fast rules per se, you know, 1, 3, 4, you know, that kind of thing. I think it just needs to be clear, like what skills does the team have? And is it in one person who hired a head of engineering and that head of engineering is already there? Or is it 4 people, but 2 of them are actually more individual contributor types who just happen to have like a larger equity stake? I just think of it as like, does the cap table seem rational to you? And so sometimes you'll see these solo founders, but like they've really recruited in 2 junior co-founders who just have like larger equity stakes than a normal employee. The 4 equal co, that's not going to work. That one we would stay away from. But I have seen like a 3 founder team where it's clear who's in charge and, you know, what the roles and responsibilities are. So we try our best to be open-minded about it if there's like good logic to support the structure. Typical though is definitely 2.
And what does your process look like if a founder reaches out, and we've co-invested together, but I think, you know, a founder that eventually wants to get to you would love to learn a little about, you know, what the process of having Zach Weinberg look at their company looks like.
Yeah, it's usually just me yelling through Zoom at your idea. No, well, that's like kind of half true. You know, we take a meeting, 45-minute pitch. If it's an industry that I know enough about, we'll try our best to make a decision on that call, like by the end of the call. Sometimes if it's an industry where either I know too much and I just need to like check my own biases, or it's an industry where I don't know anything, we'll do a little bit of like digging around from experts in the area. We'll talk to the lead, we'll do customer calls, things like that. And so part of it is just like my own, or I should say our team's own comfort level with the industry. You know, if you show up with a healthcare idea, I'm going to know a lot more about it than if you show up with like a consumer social app. So I think there's just a little bit of like comfort level. I would bet, and we don't track this, but I would just bet 50 to 60% of the investments we make, we commit on the call. That would be my guess. Now, granted, we're seeing stuff where like there's usually a lead and they're rounding out the round, and we're like the first call to round out the round. So this company has already passed a whole bunch of milestones in terms of, you know, convincing people to invest. We're not the first check in a lot of these. So I think the hit rate is higher because of that. But, you know, I don't want to make you do like 10 times more diligence. You've already done a lot of diligence usually when you've gotten to us. So, you know, I'm not going to go call every single one of your customers again, but I will call the VC who's leading and ask for their diligence report and make sure they did their homework, which is sometimes they did, sometimes they didn't. Just depends.
Cool. So we'll start wrapping up. I obviously want to leave time for you guys at the end if you just have any parting thoughts, but I have a question for both of you. So when you're looking at your angel investment portfolio, and inevitably not everything works out and not everything is a success story. So when you do a postmortem, what do you find are the most common reasons that it just doesn't happen? Like you had high conviction, everything was aligned, and then it just the cards weren't stacked right.
Yeah.
I don't know. From what I've seen, it's. Sorry, Zach, go ahead.
No, go for it. Go for it.
Yeah, from what I've seen, that one company that I invested in will be closing because they were in an industry that suffered terribly from Corona. Without going into more details, it's just force majeure. From what I've seen from companies, not that I actually have invested in, but that I was closely advising and helping. Usually, if a company fails or doesn't succeed, it's a lot of times it's internal dynamics or politics between the founding team. It's probably the single biggest and most silent killer of companies.
Yeah, we've definitely seen the founding team thing. A lot of times, like every once in a while, you take a bet that there's a market and it's just not there. It's like, even if you build it, there's no money in it. And I'd say that's probably the reason for quite a few of the failures. It's just, look, you tried this thing and people don't want to pay for it, or it's too expensive to make, or, something along those lines. And then, coronavirus has definitely killed a few, which was unfortunate because a lot of these companies were actually doing well, on their own. I would say the number one beyond that is competition. There's some competitor who is just beating you, and you got it right. Like the market was there and kind of had the product area right, but you were just like fourth in line, and someone got there first, and then someone got there second, and that's it. It's like a slow death. That's the problem with those ones, because you feel like there's something there, because there is, but it's just not yours. And those ones are really tough because, the founders are, you see like little tidbits of success. I actually think the ones where like the whole thing doesn't work are honestly better, because at least like, look, it wasn't my fault. Well, it wasn't, it's the market's fault. And yeah, we've had a few. The coronavirus ones are the worst to see. Now we've had like 3 or 4, either in travel or in real estate, that were kind of brutalized. And these are like companies that were doing well beforehand. So.
And how do you guys think about follow-on capital?
We'll do pro rata through the A, usually. Although now with like the valuations that some of these companies are raising at, like the A looks like a D. So you're like, I don't know, man. It's just trying to. You don't want to get, at least in my opinion, is like as an individual investor, you don't want to get too concentrated in any one of these. But our policy is usually to do pro rata through the A, and then later stage pro rata will very rarely, but kind of like on a one-off basis, we'll look at it. It's tough. The numbers get really, really big as the valuation gets bigger.
Oh yeah.
Sure.
Great. So, we're just rounding out the hour. We are so grateful to you both, Zach and Micha, for spending time with us today. It's been a real pleasure. Thank you for sharing your thoughts and experiences with the audience. It was really valuable.
Thanks, Nicole and Elias. It was a pleasure being here.
Thanks, Ed.
Thanks, Zach. Thanks, Micha.